In 1929, the stock market felt unstoppable. Newspapers spoke confidently about a permanent new era of prosperity. Banks encouraged borrowing. Ordinary citizens, teachers, factory workers, small business owners, began buying stocks for the first time. The belief was simple. Prices would keep rising. Risk seemed like something from the past. But markets have a way of exposing overconfidence. And when the collapse came, it did not arrive politely. It arrived violently. Within weeks, billions of dollars disappeared. Investors who believed they were building wealth discovered they had built leverage. And leverage collapses quickly. From this devastation, a new philosophy emerged. A philosophy that did not rely on optimism. A philosophy that did not assume markets were rational. A philosophy built on protection. Its architect was Benjamin Graham. And decades later, that philosophy would shape a young investor from Omaha named Warren Buffett. This is the story of how the Great Crash created value investing. To understand the crash, we must understand the optimism that came before it. The 1920s were known as the Roaring Twenties. America experienced rapid industrial growth. Automobiles became common. Electricity expanded into homes. Mass production increased efficiency. The future looked mechanical, efficient, and endlessly progressive. The stock market reflected this confidence. Between 1921 and 1929, the Dow Jones Industrial Average increased more than fivefold. Speculation became fashionable. Buying stocks was no longer seen as risky. It was seen as modern. And margin trading accelerated everything. Investors could borrow up to 90% of the purchase price of stocks. This meant a 10% rise in stock prices could double your money. But it also meant a 10% fall could wipe you out. Most investors ignored that second possibility. Because in a rising market, caution feels unnecessary. And in times of optimism, discipline feels outdated. The market peaked in September of 1929. Then uncertainty crept in. Small declines triggered concern. Concern triggered selling. Selling triggered margin calls. And margin calls forced even more selling. On October 24th, panic began accelerating. 5 days later, on October 29th, now known as Black Tuesday, the collapse intensified. Billions of dollars in market value evaporated. The decline did not end in days. It continued for years. By 1932, the market had fallen nearly 90% from its peak. The economic consequences were devastating. Banks failed. Unemployment surged. Trust in financial markets collapsed. But from this destruction came reflection. Some investors blamed fate. Some blamed government. But one man studied behavior. Benjamin Graham had built a successful investment partnership before the crash. He was intelligent, analytical, and disciplined, or so he believed. Yet he suffered severe losses during the downturn. Instead of quitting, he asked a deeper question. Why did intelligent investors still lose so much money? His answer was uncomfortable. Markets are not consistently rational. Prices can detach dramatically from underlying business reality. The market is influenced by emotion. Optimism in good times. Panic in bad times. Graham realized that price and value are not the same thing. Price is what you pay. Value is what you receive. And those two numbers often diverge. That insight became foundational. Graham began focusing on intrinsic value. Intrinsic value is the true economic worth of a business. Not what the market says it is worth, but what careful analysis suggests it should be worth. He examined earnings, assets, liabilities, cash flow, business stability. He understood that markets swing between extremes. Overconfidence pushes prices too high. Fear pushes prices too low. An intelligent investor must remain detached from both extremes. Graham famously described the market as a voting machine in the short term, and a weighing machine in the long term. In the short term, popularity dominates. In the long term, fundamentals prevail. From this thinking emerged his most important principle: the margin of safety. Because intrinsic value can never be calculated with perfect precision, an investor must demand a discount. If a company appears worth $100, you do not buy at 100. You buy at 70 or 60. That difference protects you. It protects you from analytical mistakes. It protects you from economic downturns. It protects you from market volatility. Graham understood that investing is not about being right every time. It is about avoiding catastrophic mistakes. Survival is the foundation of compounding. Without survival, growth is irrelevant. Years later, a young man became fascinated with these ideas. Warren Buffett read Graham's work obsessively. He applied to Columbia Business School specifically to study under him. Buffett embraced the framework completely. He believed in intrinsic value. He believed in margin of safety. He believed markets could be irrational. In his early career, Buffett followed Graham's approach strictly. He purchased deeply undervalued stocks. Sometimes these were struggling companies. Sometimes they were obscure. But they were cheap relative to assets. Buffett called them cigar butts. Companies with one last puff of value left. This strategy worked. But over time, Buffett refined the philosophy. Buffett recognized something subtle but powerful. A great business can compound value for decades. A mediocre business, even purchased cheaply, often struggles to grow. So he shifted. Instead of buying only statistically cheap companies, he began buying wonderful businesses at reasonable prices. Businesses with durable competitive advantages, strong management, predictable earnings, pricing power. Companies like Coca-Cola. Companies capable of compounding capital over long periods. This was not a rejection of Graham. It was an evolution. The margin of safety remained. Intrinsic value remained. But quality became central. The crash of 1929 feels distant. But investor psychology has not changed. Every market boom creates optimism. Every bull market convinces participants that this time is different. And every downturn exposes excessive confidence. The principles born from the Great Depression remain relevant because human nature remains consistent. Fear, greed, overconfidence, impatience. Value investing does not promise excitement. It does not promise speed. It promises discipline. It promises rationality. It demands patience. And patience is rare. The Great Crash destroyed enormous wealth. But it also created intellectual clarity. Benjamin Graham built a framework rooted in caution and analysis. Warren Buffett expanded it with quality and long-term compounding. Together, their ideas shaped modern investing. Not because they predict markets, but because they respect uncertainty. Value investing was not born from optimism. It was born from collapse. And sometimes, the most enduring strategies emerge from the most painful lessons. In investing, survival comes first. Growth comes second. And discipline outlasts excitement.